Hello, everybody, and welcome back to another episode of the Multifamily Investing Academy. And I have a very special guest here today, somebody that is actually going to teach me. I know what you're all thinking, like Charlie, how can anybody teach you? You are the expert at multifamily. And I say, no, wait a minute. Wait until you meet my guest here, Brett Swarts. He is the CEO of Capital Gains Tax Solutions. All right. So we are going to be talking about a concept that probably many of you have heard the term for. DSTs, but what we're going to be talking to Brett about is exactly how you use DSTs, how they can rival 1031s. Let me tell you something. And Brett, I'm going to make this announcement right now. I'm lived the last 20 years down in Massachusetts, so I am wicked smart. But the thing, because I can say that because I know for a fact that Massachusetts actually invented the United States. I saw that T-shirt at the 4th of July parade, so I'm holding that out to be the case. So let me just tell you, what you have to understand when I give Brett's bio is, he comes from, as I mentioned this one time before, my podcast with Mike Bull, that he comes from the dark side. Okay, so he comes from the brokerage side of the business. So, but we're not going to hold that against him, and we're going to learn from him. But the thing is, he's kind of, as he said, he was active commercial real estate broker and investor himself. But he came over from from one of the biggest commercial real estate brokerage houses in the country. Hey, Brett, can you share numbers? Can you share names?
Yeah, Marcus and Millichap.
Yes. Never heard of them before. Hey, Brett, are you familiar with a thing called LoopNet?
Yeah, and CoStar, right? And maybe
where deals go to die, as we always say.
Oh yeah, yeah, often.
Yes. So Brett is married, beautiful wife Melanie, with their 4 daughters and 1 son. So he's got 5 kids. Okay. Now here's the difference between Brett and me, and I want to highlight this. So I have 4 kids. Now, what that means, one of 2 things: either my wife is smarter than Melanie because my wife figured out what was causing it and stopped doing it. That could have been the situation. Or the fact is, the other flip side is that Brett's a much better salesman than I am. Maybe that's what the real reason is. But maybe we'll find out before the end. Hopefully not. Okay. Anyway, Brett, welcome to the Multifamily Podcast, where anything goes.
Thanks, Charlie. Thanks for having me. I'm excited to be here.
Good. All right. Now, listen. I'm looking. When you sent me over some of the questions to ask you, and I went through them. I'm thinking to myself, holy cow, I've got a pretty big job in front of me on this podcast to really figure out exactly, how a guy like you can be used, how we can tap into your expertise and your knowledge base on solving problems. Okay, so let's. So I'm gonna interview you like I've never done this business before. Okay, so let me hit you with the basics. Let's start with that element that probably everybody understands: a 1031 exchange. So yeah, so go ahead and give me your primer on a 1031 exchange.
Sure. Well, the IRS and the government, they give us different legal loopholes to defer tax in order to spur the economy and keep money flowing. And so the 1031 is one of those tools which allows someone to trade like-kind real estate into like-kind real estate of equal or greater value within a 45...
Okay, wait a minute, hold on. Like-kind real estate or like-kind investments? Because real estate would be like-kind, but real estate and an antique car collection would not be.
Yeah, and they've recently also, Charlie, if you don't know, your listeners may not know, but with the recent Trump tax plan, they made it even more specific. So it's basically at this point commercial real estate, investment real estate for investment real estate. It's become even more narrow. And as you know, they may take it away. A future administration who may, if they get in there, they see it as a way to pay for some of the $22 trillion in debt that they have. But it's a legal way to defer capital gains taxes as long as you roll it into equal or greater value within a period of time. And typically, most of our clients, they pick the three property rule, which means they identify within the 45 days 3 properties, and they close on all 1, 2, or 3 of those within 180 days. Now, remember, you have to replace the debt and basically the purchase price. So that's the other thing. You're staying in the debt. and you're staying in the marketplace, but it's an excellent tool, especially if you're a commercial real estate owner who can find a value add forced appreciation opportunity.
Okay, now when you say you keep the debt and you keep the purchase price, so let's say, for instance, I have a $2 million property with $1 million mortgage. What can I do on a 1031 exchange with those numbers?
Right. So if you sold for $2 million minus the closing costs and commissions, right, you need to buy something with $2 million or greater, which again, if you had $1 million in debt, which means you have to at least take $1 million in debt. Now you could actually buy something all cash. That would be okay too. But most of our clients are going to replace that debt. Which is a part of what happened in 2008, which we can talk about the why behind. By the way, the Deferred Sales Trust for your listeners versus the Delaware Statutory Trust. Most people know the DST as a Delaware, and they get confused. Right. We're actually a Deferred Sales Trust.
Okay. All right. Before we get into the DSTs, let's continue on with the 1031s. So I have to buy at least a $2 million property, but obviously if I've got $1 million of cash coming out of the sale of this thing, I'm going to leverage this thing up to a $5 million property. So that's it. But you're saying that I could also buy a $1 million property all cash?
No, you couldn't, because you need to buy something equal or greater value. So that would be called a boot. Okay. So there's certain rules you have to follow. Equal or greater value, which typically means you're replacing the debt, and you're also putting all of your equity into that next property of at least the value you sold for or greater.
Okay. All right. Now, let's get back to the rule. You said the 3 property rule, and you said most of your clients use the 3 property rule. I would think that most of your clients would use the other rule, and explain that other rule to us.
Are you referring to the 200% rule?
Yes, exactly.
Right. So on the 200% rule, you can buy.
Let's use that same $2 million property.
Okay. On the $2 million property, you can buy as many properties as you want to, as long as it's 200%. It's no greater than I believe it's no greater than 200% of that 2 million. But most of them don't even do that one. They just stick to just the 3 property rule.
Okay. Now, the real problem with the 1031s, not only just the making sure the numbers like you've been talked about work, the real problem with the 1031s are the time frames involved. Talk about those for a second.
And the biggest challenge with the 1031 is what we call the candle burning at both ends. And this candle represents your return. So imagine you have a candle, and as the candle burns, your return gets smaller and smaller. So what's happening right now is people are selling high in the seller's market, and 180 days later, they're buying higher. So they're selling high, buying higher. What's burning? Well, part of what's burning is the cap rates are going lower and lower on one side. The other part is lower and lower inventory, coupled with rising interest rates in general, although we've had a little softening in this past quarter. But before that, we've generally the last 5 years have been rising a little bit. So you sell here, 180 days later, you're buying at a lower cap rate with less inventory, with a higher interest rate, which means your candle eventually gets smaller and smaller and smaller for your return. So it's not favorable to time the marketplace, okay? Our parents taught us to sell high and buy low. The 1031 is not favorable. The second thing the 1031 is not favorable for is what's called the depreciation schedule. The depreciation schedule travels with your 1031 exchange. In other words, if you have a property that's fully depreciated and you buy into a 1031 deal, you need to buy an even bigger property just to get more depreciation. That's not favorable for you, especially if you own property greater than a certain amount of years, depending if it's multifamily or commercial. Commercial is 39 years, multifamily is 27 and a half years. So those are the two main things that the 1031 is not good: timing, depreciation schedule, and having to overpay for properties when otherwise you might not pay for it.
Okay, so along comes Brett Swarts with the solution, which is a DST, correct?
A Deferred Sales Trust, which is also known as a DST, right? But not to be confused with a Delaware Statutory Trust.
Okay, is a Delaware Statutory Trust just a misnomer, or we're using the wrong terminology, or is it a totally separate vehicle?
A Delaware is like a 1031 exchange. It's actually a form of 1031. It's like a TIC, a tenant in common. Basically, It's a mutual fund of properties that a big corporation owns, and they close on it, and you can 1031 into that. and keep tax deferred and getting non-recourse debt. I've done Delaware's as well. So it's just really another form of a 1031, whereas the deferred sales trust is an installment sale, separate tax code.
Okay, so before we get onto the DSTs, let's go back to the 1031s. One of the things another limitation of the 1031s has to do with the like-kind transfer. And also, it's very important how you own that real estate, like as you mentioned, as a TIC versus as an LLC. Talk about those limitations.
Absolutely. So a 1031, generally speaking, most syndicators and operators that I work with, they don't even accept 1031 money. They just say, come to me with new money. We're going to own this property together. We're going to add value. We're going to sell it. And then we're going to pay individuals back out and they're going to pay the tax. In other words, the whole entity must move, generally speaking. And so they don't even deal with that. And or if it's just a partnership, the same thing. There used to be a strategy where people call the drop-in swap, where they're dropping it into a different LLC and then they're moving out. But those are being more and more scrutinized now. So again, the 1031 is basically under attack, and it's out there, and they're looking for ways to restrict it, maybe take it away. But most of the clients we work with, the 1031 is it's not always an option. So that is a challenge for the 1031. Whereas the deferred sales trust, it's very, very open.
Okay, so it's becoming less. Everybody was screaming, "Oh, 1031! We've got to do a 1031 exchange." Even it drafted into our purchase and sale contracts are the term as a paragraph saying, "Hey, this could potentially be a 1031. Make sure both parties are on board with the 1031." Now you're telling me that 1031 is kind of not the favored child like it used to be. It's now it's much more. It's too tough to work through.
No, I think it's an amazing tool when it's a buyer's market. Okay, I think every tool has its place and has its solution when it makes sense to buy. And let's just think of the 2008 crisis of what happened. Part of the people who got in trouble in commercial real estate is they sold really high in 2004 and 2003, and they did a 1031 exchange, and they took on equal or greater debt, and then they did it again in 2006, and they did it again in 2007, and all of a sudden the cards fell, and they're stuck with this debt, and the values dropped. And so we call that dumb debt, actually, when you double down in a highly appreciated marketplace and you overpay just to defer the tax. So a 1031 in that scenario, I think is really risky. I think a smart debt is when you buy it very low and you actually, 5 years ago when it was a buyer's market, that's the best time. Leverage, take advantage of low prices. That is smart debt. Risky debt is right in between when you kind of just hang on. You don't necessarily sell, but you're just sitting there and the prices are rising and you're just kind of hanging out. You're not necessarily doubling down on the debt. So that is something to consider when you're looking at your tax deferral plan.
Brett, I got to tell you, you call it dumb debt. What the rest of the country, the other 58 states call it is California investors. Just say it. Just say it. Now, I know you're from California, so you know what I'm talking about. Don't deny it. Come on. You didn't.
I was in the middle of it. The Bay Area in Sacramento. Sacramento was one of the hardest hit, and I watched clients just get hammered and lose everything. Because of exactly what we're talking about. They didn't have an alternative to a 1031. They felt forced and pressured to overpay. There's no way I'm going to pay this 30 to 50%. I'm getting wiped out on my gain I've worked all my life for. I'm going to do a 1031. I'll make it work. I'll cut expenses. I'll be the manager. Whatever they thought could happen. But things hit the fan and they weren't diversified. They were in a single product type and a single geographical location with themselves. In other words, they weren't diversified.
Yep. And then the cap rates, you can't, once those cap rates start to move, you can't control it. It's like an earthquake, a tidal wave. So listen, hey, I was there. And any of these people, here I am going to go pick a fight again. Anyone that goes out there and tells you that you can buy multifamily property and overpay for it because the prices just continue to go up was never alive during the last cycle. So, that is the biggest pile of horse manure I've ever heard. So, I believe me, Brett, unfortunately, you're singing my song, and I hope I never hear that song again. But anyway, but it's no longer a buyer's market. This is a seller's market we're in right now. So, if you go out there and you're looking to either buy, sell, or syndicate a deal, talk to me about what Brett Swarts and his company can do as far as the DSTs go and how that works in this scenario.
Okay, yeah. Let me talk a little bit about the big demographics too, and then we'll nail down on the strategy. So, according to the American Bankers Association, Charlie, there's about $17 trillion that will actually pass from your generation, known as the baby boomers, to my generation in the next 20 years. And this is the
You know,
largest.
hold on a second, Brett. I really don't appreciate that. I mean, why are you able to just you can look at me and think I'm a baby boomer? I mean, come on. I mean, my wife is not a baby boomer, and we are 1 year apart. We are 1 year apart, and she never lets me forget it. And now here you are. Now, granted, I tell everyone I'm 72 years old because that's the only way anyone says I look good. So fine. Go ahead, throw me in that category. You're right, by the way, and I don't appreciate that. But go ahead.
And it's also for the wisdom that we can learn from your generation, right? Come on,
from all the mistakes I've made.
But the stats are really real. There's about 10,000 baby boomers in the U.S. alone turning 65 every single day. There's about 77 million in the U.S. alone. Okay, and they feel trapped by capital gains tax and depreciation recapture on what? On businesses, on commercial real estate, in primary homes, which, by the way, represents 50% of America's total net worth is tied to businesses, primary homes, and commercial real estate. And they're looking for ways to transfer this wealth and retire from toilets, trash, liability, have liquidity and diversification without giving 30 to 50% of it away to the US government. And they literally feel trapped and they're not sure what to do and how to get out. And again, we talked about the shortcomings of the 1031 exchange, but what else are their options? Well, the first option is just don't sell. Just don't sell at all and you won't pay the tax. And you can hold on for life and you can give it to your kids with a stepped up basis. And as long as you're not above 11 million on your estate, or if you're single, and 22 if you're married, you're in good shape. They can walk away tax-free with that stepped up basis once they receive it.
Yeah.
But again, you've earned your wealth for 30, 40, 50 years of work. Maybe you don't want to have to wait for another 20, 30 years before you tax it. Give your kids a bunch of money. You want to enjoy your wealth. You want a passive income stream. But here's the second part of that. You want diversification, okay? What happened in '08 was a big deal, right? Where people were in too much debt and they weren't diversified. And so the Deferred Sales Trust gives that diversification. The other thing is you want liquidity, the ability to access the funds and go enjoy it if you want to. Now you're going to pay tax on whatever you access, but the Deferred Sales Trust, I like to call it like the screwdriver versus the 1031, which is a hammer. The 1031 is a hammer and it works for certain situations. Great if you can use it, if it fits your goals. But maybe you want to use a screwdriver to fit your goals. And so what do we do? Well, the Deferred Sales Trust, first of all, it's an alternative to a 1031 exchange. It works for the sale of high-end primary homes, businesses, or commercial real estate.
Okay,
also,
hold on a second. Yeah. When you use the term high-end primary residences, what do you mean by that?
And better way to say it would be highly appreciated, because I'm doing deals right now in the Bay Area where it's a house that's worth $2.5 million, but it was built in 1950s, and you wouldn't think it's high-end. It just sits next to Facebook or Google, right? And they bought it 30 years ago for $200,000.
Yes,
so
exactly.
Better way to put it is highly appreciated primary homes, right? Okay. Where you have somebody who can't even afford the rent down the street and they feel trapped in their home and they're on a fixed income. And this is our passion about what we do. We provide freedom from capital gains tax. We get them out of their asset. Maybe they can move with their kids, grandkids on another state, get a passive income stream from a commercial real estate syndicator, defer all the capital gains tax, and get out of their house. Otherwise, they go, I don't want to sell my house and pay $1 million in tax. I'll just live here. So we're solving that challenge. The other one is for the business owner. The business owner who wants to retire today and take advantage. We've worked with veterinarians, dentists, and maybe they want their time back. Maybe they want to work until they're 60. Maybe they want to retire at 45. Well, if I can sell your business today, let's say for $5 million, and help you defer $2.5 million in tax, that just gave you time back versus what you would have to wait for, let's say, a $7.5 million sale to net you the same amount of $5 million after you pay the tax. So we give back time for people to be passive from their day-to-day work, from their toilets, trash, liability, and then we get them debt-free out of everything, and then we diversify it. And then if they want liquidity, they can keep it in stocks, bonds, and mutual funds, and they can access the cash, and we call it trade plus 3. Again, back to the baby boomers, they want the ability to maybe travel the world, maybe to buy a nice car, but they don't want to have to refinance or sell a property in order to do it. So this, you can incrementally pay the taxes along the way.
Okay, so let's talk about this. from the nuts and bolts standpoint about how you set up the DST. And we'll talk about it from the seller's point of view, but then we're going to talk about it, before we end this call, we're going to talk about it from a syndicator's point of view. So let's talk about it from the seller's point of view. I own a $5 million property. It's got $2.5 million of equity. Let's say I own it myself. And I listen, everyone's telling me about the 1031 exchange. Like for me to make this work, I've got to run out and I've got to go identify 3 properties and in a rising market, so along comes Brett Swarts and he starts telling me about this thing called a DST. And I like what I hear. So how do I go about doing this? Because the thing is with a 1031 exchange, what we're looking to do is I tell all my students and clients, you got to find a QI. You got to find a qualified intermediary. The laws on 1031 exchanges are too esoteric. I don't know them. You got to go talk to a QI to see what you need to do. What do you advise somebody in my situation to do?
You understand the law and the structure, and you bring in your trusted advisors to get their approval. Okay. So my role in this, Charlie, is we call it the guide. Okay. And the brain surgeons and they're the CPAs and tax attorney. Another word for guide would be like the nurse. So Charlie, first of all, I take your pulse and I say, okay, what is your tax liability? What are your goals? What are you trying to do? Okay. Well, you might be a good fit for the Deferred Sales Trust based upon what you've said. And let's connect you with our brain surgeon. But before you get surgery, bring in your brain surgeon, your CPA, your tax attorney, make sure they have their blessing before moving forward. But practically speaking, understanding the first part of it, which is IRC 453, which is the seller carryback, Charlie. So I want your listeners to understand that this law goes back to 90 years, okay? And they actually probably know seller carryback, and their CPAs definitely do. But let's just walk through a scenario. You're selling a $5 million deal, Charlie. Let's imagine your basis is 0. You've owned it for 30 years. And you're going to pay about 37% of that in tax. Call it 40% with depreciation recapture. So it's a significant tax bill. You definitely need a tax referral strategy. You're committed to doing that. So you have a buyer lined up and he's ready to pay you $5 million, top dollar for your property. You decide not to do a 1031 exchange. And here's why. You say, I want to do an installment sale with the trust to keep it deferred. Taking one step back though, imagine I came to you, Charlie, and said, I'm going to give you a 0 down payment, Charlie. Would you carry a note for $5 million? Just a regular seller carryback. In that scenario, Charlie, if you receive 0 down payment, you're in what's called, you don't owe any tax right now. You're in a deferral state. You carried a note for $5 million. In a traditional deal, you wouldn't do that because I have no skin in the game and I could run your property into the ground. You may have to foreclose, right? The other reason you wouldn't do that either is I'm probably going to pay you back in a couple of years anyways, and you're going to be in the same situation you were before. Well, the Deferred Sales Trust, they're 10-year notes, and you can renew every 10 years for 10 years. But the only difference is what we do is we have the trust jump in right before close of escrow. And it says, Charlie, I'm going to buy your position for $5 million. And that buyer's already lined up over there. As soon as it closes, I'm turning around, I'm selling it to that buyer for $5 million. The $5 million goes into the trust, and Charlie gets a note for $5 million. Now, Charlie, if the trust bought for $5 million and sold for $5 million, how much gain does the trust have?
0.
And now, Charlie, you're correct. And if you took 0 down payment, how much tax do you owe today?
0.
Got it. So that's how this works. It's as simple as that. We have a third-party trust, which, by the way, must have business purpose, must be able to make a profit, must be able to make a fee. This is how we've been tested 14 times by the IRS, and this is how we maintain the integrity of the trust. Second, over 2,000 of these have been closed. Third, we have 1,100 professionals across the U.S., including CPAs, tax attorneys, law firms. The largest deal is over $100 million. So we've been tested. We're not coming to you, Charlie, and say, hey, listeners, try something new. We've already blazed the trail. We already have the scars to prove it. And by the way, all those audits were no change audits, not one single issue, because this is what the IRS said. You guys are just doing an installment sale. You're being creative on how you're doing it, but it's just an installment sale. And so I'll pause there because you might have some questions.
Okay, well, my first question is, who's the trustee? Who's the beneficiary of the trust?
So that's what, yeah. So Capital Gains Tax Solutions is the trustee. Capital Gains Tax Solutions is the beneficiary, okay? You, Charlie, are the creditor. But the second question you should be asking is, well, what rights do I have as a creditor? And why aren't I the beneficiary? Well, the first thing is you have all the rights, just like a bank would, Charlie. If a bank comes to you, or you come to a bank and say, I want a loan on this property, I want to buy this property, they have all of these rights that are in place that should the property sell, they're only going to sell if they get paid. Well, it's the same concept here. You have all of those rights and protections. The funds only ever move with your signature, but it is a shift from ownership to a creditor, okay? It is a shift, and this is how we maintain non-constructive receipt. And if you think about it, it's sort of the way a 1031 works, right? When the funds are in escrow, what you're doing, you're saying, no, I don't want to take constructive receipt. Send it to that QI company over there.
Right.
Okay. And if they mess up and send it to you, it's over. Right. So you got to make sure it's all lined up. And then they hold the funds. And then what do? You perfect an exchange and you keep doing that. It's the same concept. You're just sending the funds to this trust and it's non-constructive receipt because you haven't taken the funds and you become the creditor. Okay. And the next thing is, well, how do I know the funds are protected? Well, first of all, they never ever move without your signature. Before the funds go anywhere, you decide on a risk tolerance, how and where you want the funds invested, stocks, bonds, mutual funds. You can hire your own financial advisor, okay? He'll have to join the greater our organization and work out a referral fee, but he can join us and he can do it, or you can use one of ours across the U.S. And also there's audit protection built into every single trust as well. In case you were audited, the tax attorneys will defend you. So I'll pause there again because you might have some more questions.
Well, no, I was just trying to think here that when the money goes into the trust, how can I then turn around and say, oh, I want to buy this $10 million commercial property?
By partnering with your trust. So Charlie, you form a brand new LLC. I don't know if you ever worked with any self-directed IRAs.
Okay, yeah, sure.
Self-directed IRA can go into stocks, bonds, mutual funds. It can also go into commercial real estate deals by directing the funds to that deal, right? So it's the same thing. Charlie, you form a brand new LLC and you're looking around for partners. It's a $10 million deal. And you may partner with Brett, George, James, but you may just say, you know what, I just want to partner with my trust. And so it's a 90-10 split where you're the managing member of the LLC, even though the trust may put up 100% of the down payment. Trust is a silent partner with you. Okay?
Just like a Class B member interest in a typical LLC. But wait a minute, I am now, I switched from being the owner of the property to now a creditor to a trust. But what legal authority do I have as a creditor to the trust to tell the trust, okay, now you're gonna partner with me on this real estate deal?
So the legal authority, as a trustee, we have to. Let me back up. You fill out a risk tolerance questionnaire before the funds go anywhere, and based upon that risk tolerance questionnaire, the note is basically assigned an interest rate. Most of our notes earn 8. And that's the payout, okay? Payout of about 6.5 after fees, okay? And that becomes the constitution for how and where the funds are invested. So as long as the investment is something that is within that risk tolerance, the funds can be directed there, okay? So as a trustee, I do have to approve the investments, right? And I have to say, yeah, that works, right? Yeah. Based upon what the trust it was set up for. So technically, no, you can't direct because that would be actual receipt or constructive receipt.
Constructive receipt.
Yeah, but it is, hey, here's an opportunity. Does it fit the risk tolerance? Yeah, that looks good. Okay, sounds good, Charlie. Let's do that deal. So we are working together to make that happen. I can tell you this: I've yet to be approached with an opportunity where we said no to because our only concerns are out of country. Okay, no primary homes because that's actual receipt. We really love commercial real estate, and we're going to stay within the U.S. That's really where we're at.
So when I set up this trust, I say, here are the investment parameters. And I basically say the same thing that you just said there. You're going to say yes to whatever it is I want to do. I mean, even if I say, hey, I want to just do it in gold. I want to just invest in gold.
Yeah, we're going to look at the risk associated with it. Okay. And so we might tell you, if you want to do all that in gold, we might say, Charlie, you might want to just cash out of that portion, pay the tax, and then go put it in gold, right? If you want to go jump off a cliff, right? you can jump off the cliff. We're going to advise you not to, and we might say, hey, realize this is what's happening here. You're taking on a bigger part of a risk that could affect the ability to pay out. But also, by the way, if you want to cash out at any point, all of it, you can cash out. Just say, hey, I want to cash out, pay it, pay the tax. But there's going to be some disclaimers there because we don't want to put any unnecessary risk on the structure as a whole. But most of our investors, they're moderate, aggressive on their risk, and they're really happy with the 8%. But when they partner with the trust and they get the 90-10 split, even though the trust puts up 100% of the down payment, they're getting all that other upside to them personally, which, oh, by the way, they can roll back into the trust too. So you're asking hypotheticals, and I appreciate it, but we haven't really faced that, I guess, is the best way to put it.
Okay, but just so everybody understands, and tell me if I'm wrong here, the issue that you would have as the trustee for me putting everything into gold is the lack of diversification.
Correct.
And that's it. It's not like, hey, gold's a good investment, but not everything in gold.
Exactly.
Okay.
The allocation is going to be presented to you, and that allocation is going to be signed off by you, the creditor, before the money goes anywhere. And you can change that allocation along the time. Every 6 to 12 months, we can do what's called a refinance. It doesn't cost anything to refinance, and you can adjust that based upon your lifestyle and your needs, right? And how much income you want to receive. So it is adjustable and it is flexible. I want to let you know that, but it's not something where you're directing an E-Trade every day, or you can take on too much risk. By the way, 80% of the funds can be directed to outside investments like commercial real estate. The other 20% must stay within the liquid investments and diversified portfolio.
And that is strictly just to make sure that you're not being foolhardy with the trust funds as the trustee.
Yeah, so we want to protect you, the client, and we also want to protect the structure. So in the 23 years, we've had none. Every financial advisor we've worked with has been able to pay out what they thought they would pay out over a 10-year period, which after fees it's going to net about 8%. Past performance is not a prediction for future results, but generally speaking, it's been able to work. So we don't want to put any enormous risk on you or the structure.
Okay, so essentially, I've got two options as an owner of a multifamily property that I'm about to sell. I can 1031 exchange it, and then I'm tied to all the limitations and the risks involved with buying a property in a rising market. Or I can go with the DST where I just say, take my proceeds off the table, stick them in a trust, and as I see fit, maybe 2 years from now, I find a sweetheart deal on multifamily, and I'm going to grab some money out of my trust to go pay for it. And that the IRS has not hit my money with the capital gains on that property because it hasn't been sold yet. I have not received these funds yet. That's basically it.
100%. You direct them to an LLC and you partner with the trust, and you went and bought a property, and that's not actual or constructive receipt. Now, if you cash out of those funds and actually take actual receipt, then you'll owe cash on that given amount. And that's what some of our clients will do, Charlie. They'll just slowly bleed out a principal every year, a percentage, and pay the tax slowly because the tax is owed. It's just not due today. It's just in a deferral state, which by the way, that's why the 1031 works too. It's just deferred. When does a 1031 end? Well, when you finally sell the last property and cash out, unless you do the stepped up basis. That's the
point. I mean, the government wants their pound of flesh at some point in the future. Everybody knows that. It's the same thing with your IRA or your 401k. Hey, you're 72 and a half or 70 and a half, you got to start receiving this money so we can start getting taxed on it. It's the same thing. All right, let me ask you this. Now we're going to turn to the flip side here. And I just have to, as a disclaimer here, Brett, I just must say that we're having a massive thunderstorm here in my town. And if I lose power, I am going to be bummed because I got some good questions coming up for you. So just so you know, and we'll edit the whole thing. We'll be back on. And we'll edit the whole thing together. But anyway, I have two questions for you, but they're coming from the buyer's standpoint. So we just went through understanding what a DST does from a seller's point of view. Now I want to talk to you about first off, how can we as buyers use this to our advantage in trying to pitch our offer to a seller and say, hey, listen, let us help you structure it this way. That's number one. And then number two, I want to talk to you about syndication. Where you talked about, let me see if I can, how do I grow my commercial real estate investment syndication business using the DSTs. So those are my 2 points, because I'll tell you, you just gave us a great education on from the seller standpoint, but the majority of my clients and students are on the buying standpoint.
Yep.
How can we use this?
Yeah. So when you're calling an owner, right, you're doing your marketing, you're trying to find an off-market listing. Those owners have a problem, and if they're already motivated at all.
Can I just stop you for a second? Did everybody just hear what he said? I mean, and Brett doesn't even know who I am. He has not followed my training at all, but I teach that all the time. All sellers have a problem. Even if everything's going swimmingly for them, there's some reason why they have to sell or want to sell. That's their problem. You need to identify what that problem is and then come up with the solutions to solve that problem.
Exactly. You got to come up with a solution to solve their problem. So let's say they're getting 10 calls every 14 days by brokers, by these people. They're getting the letters. They know it's a time to sell. And they just keep getting all this stuff. But you know what? They look at wow, that's a great offer, but I'm going to pay 45% in tax.
Yes.
And, I don't want to trade my units for more units. And I'll give you actually a live example. Just closed this deal 3 weeks ago. Okay. This gentleman, his name is Peter. He's driving from Marin, California to South Sacramento. And he's going to approach all the time for offers. And he goes, I go, why did you use the Deferred Sales Trust? Why didn't you do a 1031? He goes, Brett, I'm approaching 70 years old. I'm a real estate broker. I've done 1031s all my life. I have 18 problems. South Sacramento is one of the hardest places. He's driving up, banging on doors. I think he got a gunshot in his car one day. I mean, it's a nightmare going up there and trying to manage this stuff. And he goes, Brett, I didn't want to trade 18 problems for 36 problems. Okay. I'm ready to be done with all this. I want to enjoy my hobbies. I want to travel with my wife. I want to just not have to worry about this property. And he felt literally trapped. So that person you're calling him, if you're just telling him to 1031 exchange, he's probably not going to talk to you because you're not adding any value. You're telling him something he already knows. I already know 1031. Exactly. The other 9 callers have already told me 1031. They've already told me the Delaware, but the Delaware doesn't give me liquidity. The Delaware, I give up all my control. The Delaware, it's a 10-year term. And then I'm maybe having to go back into another deal. So I don't necessarily want the Delaware. Delaware has really, really high fees and typically pretty low returns. So I don't even want to do a Delaware. But they actually want liquidity. They want diversification. They want to be debt-free. Okay? And they want a passive income stream that they can spread across multiple commercial real estate syndicators. And so what I'm doing right now about the California real estate, I'm having my clients sell these high prices, and I'm having them go to syndicators out of state, in particular mobile home parks. And it's got to be value-add multifamily if you can find it anywhere. That's really my niche. And so I'll partner with them in those deals, put my own money in the game with them. But they're selling high and they're diversifying, maybe with 2 or 3 operators across the U.S. in 2 or 3 different geographical areas. So they're diversifying not only their commercial real estate holdings, but the locations within the U.S. Remember, the 1031 is typically one asset for another asset, which means you're going from one location to another location, typically in the same product type. And so this gives you all the product types, senior housing, mobile home parks, whatever you want to do with niche operators. So how are you solving their problem?
Hold on.
Yeah.
Let me see if I get this straight. So the guy sells his 18 units in Sacramento. He puts it into a DST. You've written a trust document such that it pays him an 8% return out of that money. He's going to be taxed on that the same way he would if it was an IRA contribution, but he gets to keep that money in a trust and still continue to invest it the way he sees fit in the way. It's almost like an annuity that enables him to go off and just invest his money the way he wants. There's no, I mean, you put an annuity in an insurance company, the only way, your kids are going to benefit from that is if you have a refund, if it's an annuity with a refund. Otherwise, the insurance company just takes your money and that's the end of it. So am I right? It's almost like an annuity that we've got going on here.
You can do annuities, you can do bonds, you can do treasury bills, you can do stocks, you can do mutual funds.
But I mean the whole vehicle is an annuity. Granted, it's not an annuity.
It's a note, right? And really, where are the funds invested? I just want to let you know it's totally flexible, right? It's totally flexible. Based upon what those investments do, will determine the payback. Either it's going to be a little bit more, a little bit less, but generally speaking, it's about that 8%. Is what we found. But also, he's going to get a brand new depreciation schedule. Remember, this gentleman, he had traded multiple times, and he also had $500,000 in debt. So he sold for 1.8 million, basically put 1.3 million into the trust. So he became debt free. And then he's going to get a brand new depreciation schedule for whatever he buys when he goes out there. And oh, by the way, it's other people's debt. It's non-recourse for him because he's not the person who's personally guaranteeing that debt. So he's taking risk off the table. And he's also only going to probably put, for his scenario, he'll probably put $500,000 into passive commercial real estate deals. But the other amount's sitting with the financial advisor in stocks, bonds, mutual funds, at which at any point he can liquidate up to 80% of the LTV of the total note value. So it gives him so many more options. And oh, by the way, he's a baby boomer, right? He doesn't want to deal with any more toilets, trash, and liabilities.
Okay, big question. Creditors. I mean, the guy they're coming after him, but now he's put it into a trust. Can the creditors attach the trust? Can they go after the trust? Or is he protected?
So the income, yes. Can they force the sale of it? That's some gray area. We do have what's called a DST plus, which is additional tax planning, which can actually move the funds outside of the taxable estate. If you live in California, there's also another structure that allows you to get away from the creditors. It's actually what O.J. Simpson had, where he was able to keep $100 million away from creditors. Yeah. So with additional tax planning and estate tax planning, yes, that is possible. But it by itself doesn't necessarily mean it's away from the creditors.
Okay. All right. So let's talk about first off, if we propose that as a buyer, we propose that to a seller, say, listen, we can solve your problem. I understand you don't want to sell because you're afraid of these huge tax bills that you might have coming up. But listen, let's talk to my buddy Brett Swarts, and he can talk to you about how we can solve this problem for you and using a DST, and therefore you can sell your property to me.
100%. You just provided a solution to their problem. We do the heavy lifting. Our tax attorney is the #1 installment sale attorney in the U.S. He started with Arthur Anderson. He's been for 23 years. He's out of the Midwest. Okay. And again, but we're just the nurse. We're going to take your pulse, have them bring in their trusted advisors. Let us educate them on the structure, have them sign an NDA, get their blessing before moving forward. By the way, we don't charge anything, and neither does the law firm, unless and if the deal actually closes and unless and if the client actually decides to use the Deferred Sales Trust. So to us, we just put no pressure. We're just going to educate you and say, hey, here's the tool. If you want to use it, great. If you don't, no problem. But here's all the solutions that it provides.
Cool. All right. Now, let's talk about syndicating. Talk to me about that.
Yeah. So as a syndicator, one of your primary objectives and goals is to raise capital from high net worth individuals so that you can help them have a passive income stream. Okay. So how do you do that? Okay. Back to that $17 trillion number, back to the high-end primary home, businesses, commercial real estate. Oh, by the way, if you own a business, you're very likely to want to be in commercial real estate. You're very likely to understand that world and want passive income and the depreciation. So it's a perfect tool to take illiquid assets, primary home, business, and or commercial real estate, move them into a trust, and then they can direct it to your syndication. Okay, up to 80% of those funds, right? So it's kind of like, hey, if I had a 1031 where you could move into my syndication, would you do it? Yeah, I'd do it. Well, this is sort of like that. It's called a Deferred Sales Trust, but it works for your business. It also works for collectibles. It works for artwork. It works for high-end cars. Really, you name it, we've done it. And it's just an installment sale. What we're going to do, it works for stock. It works for private stock. Highly appreciated stuff. So that's the first thing, is the ability to defer and go into your deal. Do you have a question on that?
No, I was just going to say, you keep using the term highly appreciative, and the reason why you say that is because that's the appreciation is what gets taxed, and so that's our biggest concern. If you're floating at break even, don't even think about this.
Tax.
Exactly. Yeah.
Our number is this: $100,000 in liability for every $500,000 in proceeds.
Yeah.
$100,000 in actual tax liability. The check you're going to write to the state, federal, Obamacare, you're going to write for every $500,000 in proceeds, right? So let's say you're selling a $10 million deal, Charlie, and you're only paying $100,000 in tax. I'm going to say, Charlie, pay that $100,000, keep that $9.9 million dry on the sidelines, and wait for your deal to work.
Yeah.
But let's say you're selling a $10 million deal and it's $3.5 million. I'm saying, whoa, Charlie, don't do that. Put it all into the trust on the sidelines too, right? And wait for that deal to come up and then direct it to that and on you go. So that would be the first one, to raise funds. And also, by the way, to separate yourself from every other syndicator out there. What are the other syndicators doing if they don't know about this? They're walking in and saying, sell your business for 10 million, come to me with 6 and give me 2. Well, why don't you say, sell your business for 10, net 10, and come to me with 5? Because I just saved you 2 million. Yeah. The next thing is this: when they actually sell that syndication, they have what's called carried interest. Oh, by the way, the Deferred Sales Trust works for carried interest. Okay, so your own deal, Charlie, you have $1 million gain. You can use a Deferred Sales Trust, and then the next day you have a deal, syndication deal. You can use a trust to fund that. You can do the same thing with your other investors, right? Again, as long as the numbers are big enough, but they can have their own individual DSTs, in which once it closes, they save, let's say, 40% on the amount they would have paid. Then they can direct it to your next deal, which means you don't have to raise as much funds for the next deal, and you're going to differentiate yourself. And they're going to want to tell everybody, hey, go with Charlie's fund because he has a beautiful tax deferral strategy that gets us in and out with an extra 40%. So it's a win-win-win for everybody.
Okay, now, before we get into the final part of our show, which is, oh yeah, well, what about this? And I know a lot of you might be thinking that Brett doesn't have great stories because guys, like, all he does is sit around and talk taxes all day. No, he was a commercial real estate broker for years, which gets me to my final question before the break is, first of all, how do you get paid? Your history is, you came over to this as a commercial real estate broker. Are you still acting as a real estate broker? Like, what is your role? Because when I read it, I thought, oh, this guy must be an accountant. Oh, he must be a lawyer. So, no, you came over from the brokerage side. So what's been your road to this point?
Yeah, my story is I started at Marcus & Millichap in 2006. I was still in college, just playing college hoops on scholarship, and I was, getting 2 degrees and a minor. And I took an internship at Marcus & Millichap and started to learn the investment real estate world. Right as I graduated in July of 2007, things, were going pretty well for a little while, but then the market started to shift and then it crashed. And I saw the turmoil of what happened in California. And as a part of that, our Marcus & Millichap manager brought in a gentleman who's now my business partner to speak on the Deferred Sales Trust. And I said, what's this? And like you guys, I was very skeptical. I said, this sounds too good to be true. Well, why would anybody do this? And I poked the bear for a number of years. In fact, I got my Series 22, my Series 63. I did some Delawares, but I started to send more and more referrals along the way. Fast forward, the marketplace has completely shifted from those 2010 days. In fact, it's like upside down. It's the other way. And all of this amount of business just started to roar in the last couple of years. So as of 2 years ago, I launched Capital Gains Tax Solutions as a way to educate and empower commercial real estate syndicators, commercial real estate brokers, financial advisors on this exact tool because I've been living it for over 10 years.
Now, did you have to leave the brokerage side to do that, or is this something? No, so
I have 2 companies. So Commercial Realty Apartment Advisors, where I do the same thing I've always done at Marcus & Millichap, is help people buy and sell apartment buildings, okay?
That's your team. That's your team without Marcus & Millichap.
Yeah. What's that?
That's your team within Marcus & Millichap.
No. So I left Marcus in 2011, and I was with a group of people at Sire Partners, which was old Marcus & Millichap agents. And then I launched my own company about 3.5 years ago.
Okay, cool.
So we're just a boutique firm who just specialize. We have a senior housing specialist. I'm more conventional multifamily. And then we have another gentleman who's more smaller multifamily. But yes, I still focus on that because here's the thing. I walk into a conversation and I say, look, I have a 1031 tool. I have a Delaware Statutory Trust tool. I have a Deferred Sales Trust tool. What fits? And this is what I'm trying to get people to understand, that as a commercial real estate broker, you've got to have the tools available. Otherwise, your clients aren't getting all the solutions that they need. So that's my story. I got educated. I did the deals. I closed deals, and I'm one of 13 exclusive trustees. So this is how I get paid. So my actual role is a trustee. Although I'm all about educating, kind of like Steve Jobs says, I never want you to sell. I just want you to educate. My focus is trying to educate people. I'm a salesman by nature. But I want to educate you with the tool so you're empowered. How I actually get paid is being the trustee. So we get a recurring fee once a year at close of escrow, and then once a year thereafter for as long as the funds are in the trust. It's about 50 basis points if they stay with a financial advisor. If they go with a commercial real estate deal, it's 1%. Okay, so what we always start with is what is your actual tax liability? If you're going to save $3 million in tax, let's say a $10 million deal, right? That's a big fee to pay. Do you want to pay that, or do you want to put in the trust and pay these incremental fees? The goal too is to out earn, 8% on 10 million, right? And you net 6.5 after fees. The 1% too, by the way, is to our financial advisor who's managing the funds. Not mine, but a different. He's outside of our organization. And the other fees are to the tax attorney. He charges a one-time fee of 1.5% on the first million, and then 1.25% on anything above that. Now, we're separate entities, and this is how we maintain the integrity of the trust, but we all work as a team to educate and provide the client, the note holder, with the structure.
Wow. Okay. Let's take a break. And when we come back, play our game and we wrap it up. And I want to get information on how people can get a hold of you. All right. Thanks, Brett. We'll be right back. Okay. Final segment, Brett. Are you ready to play our game?
Let's go, Charlie.
Okay. Here we go. You start off. Tell me the worst, the good, the bad, the ugly, the thing that makes your blood boil, your toes curl in this business. And I can imagine you might have some pretty good ones. Go ahead.
Well, the worst is the seller who doesn't sell at the right time and overpays. And I'll talk about a gentleman named Steve. This actually happened. This was 2007. Okay, at the beginning of 2007, this gentleman owned about 1,000 units, and he basically had a chance to sell. We said, "Hey, we want to sell." We got a friend joining us here. That's cool.
Yeah, I know. So hold on one second. I'm going to stop your video there. Hold on. Okay, there we go. Okay, we'll be right with you. We're going to edit this thing. But go ahead, Brett. I'm sorry about that.
No, the story is Steve. He could have sold his property. He said, "Steve, you're in C and D neighborhoods. You're in marginal areas. You've added value. The properties are through the roof. Sell right now. You've all this debt." And what did he do? He didn't sell. He thought he was overconfident. He lost everything.
I know. Oh.
Everything. He had built up for 20 years. He lost everything. Now, to his credit, I didn't know about the Deferred Sales Trust at the time. I didn't learn about the Deferred Sales Trust until about 2009. But he didn't sell, and he just stayed in the C and D neighborhoods, and he was over leveraged. He just kept 1031 exchanging, and then he lost it all. So that would be my first one. I'm guessing $35 million, probably net worth.
What's he doing now? Is he pouring you drinks at the country club?
He's coming back. He's trying to make a comeback, but he's nowhere near where he was before.
Yeah. Oh, that's too bad. Boy, I mean, I've made and lost millions twice. So, man, I know it. Because remember, wise guy, I'm a baby boomer, So, I've got that on you, you wise guy. So, hey, Brett, how can we get a hold of you?
Yeah, so the best way is capitalgainstaxsolutions.com. Just search for me on Google. You can also search that on LinkedIn, BiggerPockets, and YouTube and Facebook. Awesome. And just reach out to me. We have a DST calculator where if you go in, you can enter in your information, and it's going to give a side-by-side comparison to pay the tax or do the Deferred Sales Trust. Okay. We also have an online webinar. It's totally free. Just reach out to me, and we'll get you access to that. And you can actually see visually what I'm talking about here, and how this works, walk you through methodically on the structure. And our goal is just for you to be empowered with it so you can create and preserve more wealth. And if you're a business professional, so you can add more value to your clients.
All right. His name is Brett Swarts. He's the CEO of Capital Gains Tax Solutions. Brett, thank you so much for being on our show. You've been a great guest. And I think the lovely Vanna over here has a special going away present for you.
Thank you, Charlie.
Don't wait up for it. Thanks. All right, pal. Good talking with you, and I'll talk to you soon.
Okay, thanks.
Thanks.